It's now my privilege to formally welcome and introduce Governor Tiff Macklem. Mr. Macklem was appointed Governor of the Bank of Canada in June 2020 for a 7-year term. He first joined the Bank of Canada in 1984 and held various senior positions, including Chief of Research and Advisor to the Governor. He was appointed a Deputy Governor in 2004 and Senior Deputy Governor in 2010. During the global financial crisis, he was Associate Deputy Minister at the Department of Finance and represented Canada at the G7, G20, and Financial Stability Board. From 2014 until his appointment as Governor, he was the Dean of the Rotman School of Management at the University of Toronto. Friends, please extend a warm Saskatoon and Saskatchewan welcome to the Governor of the Bank of Canada, Mr. Tiff Macklem.
Thank you, Jason. Well, first of all, Jason, thank you for that wonderful introduction. Chris and Jason, thank you both for having me. The short version of my speech is your jobs are very important. So look, to all of you, good afternoon. It is a great pleasure to be here in Saskatoon. And I do want to thank the Saskatchewan Trade and Export Partnership and the Greater Saskatoon Chamber of Commerce for this invitation. Canada is a trading nation. As the Premier just outlined, we rely on exports for around a third of our income as a country. And we use that income to buy things we need from abroad. And as you said, Premier, the share of exports in Saskatchewan's GDP is even higher. It's about 45%. It's actually the highest in the country. Saskatchewan provides commodities to the world: wheat, canola, potash, oil and gas, uranium, and more. And it imports a range of goods, particularly motor vehicles and machinery and equipment, mostly from the United States. Unfortunately, trade is under attack. Globally, trade friction has been increasing for the past dozen years, and now the United States has swerved sharply to protectionism. The large increase in U.S. tariffs is weakening global demand, disrupting supply chains, raising prices, and putting the Canadian and global economies on permanently lower paths. These shifts in trade also have implications for international capital flows. Together with unsustainable U.S. fiscal deficits, persistent trade imbalances have the potential to increase financial stability risks globally. Saskatchewan, like most of Canada, is caught in the crossfire. New U.S. tariffs on steel, aluminum, motor vehicles, copper, and softwood lumber are hurting businesses and affecting workers across the country. But here in Saskatchewan, it's actually China's move to effectively block Canadian canola exports into its market that is causing the biggest trade impact. Around the world, trade is more fragmented. Trade with the United States is more difficult. Trust is low, and new risks to financial stability are emerging. As an open economy closely integrated with the United States, Canada is particularly affected. And that's what I want to talk about today. I'm going to begin with a longer-term perspective, outlining 4 megatrends in global trade and capital flows that are transforming the global, international, economic, and financial landscape. Global trade growth has slowed. The United States is no longer the dominant trading nation, but it still dominates global financial flows. And global trade imbalances are widening again. Now, President Trump did not start these megatrends, but his policies will likely reduce trade with the United States further and could dent the US dollar as the global safe asset. Then I'm going to discuss the implications for Canada and the world. Pour le Canada, les ramifications d'une nouvelle relation avec les États-Unis sont immenses. Et une chose est sûre, on ne peut pas permettre d'attendre. Les leaders du pays, chefs d'entreprise, responsables politiques et dirigeants économiques doivent tracer une nouvelle voie. On aurait dû faire ces changements il y a 15 ans. Mais le deuxième meilleur moment, c'est maintenant. Les États-Unis seront toujours un partenaire commercial essentiel. Mais il faut trouver de nouveaux marchés pour nos produits et nouveaux produits pour nos marchés. Il faut améliorer notre productivité pour être compétitif à l'échelle mondiale et on doit attirer les capitaux étrangers. Partout dans le monde, les nations et les entreprises cherchent de nouveaux partenaires. Le Canada devrait être en tête de liste. For Canada, the ramifications of a new relationship with the United States are immense. And one thing is clear, we cannot afford to wait this out. Canadian leaders, business leaders, political leaders, economic leaders need to chart a new course. We should have been making changes 15 years ago, but the next best time is now. The United States will always be a crucial trade partner, but we need to find new markets for our products and new products for our markets. We need to improve our productivity to compete globally, and we need to attract foreign capital. Around the world, countries and corporations are looking for new partners. Canada should be top of the list. So let me begin with the 4 megatrends. First, global trade growth has slowed. You can see this in chart 1, which shows global trade as a share of global GDP. And what you see is that in the first 65 years after the Bretton Woods Agreement was signed in 1944, global trade grew faster than the global economy. Open trade brought specialization, innovation, and economies of scale. It drove investment and productivity. For consumers, open trade increased selection and lowered prices. Trade spurred income growth across countries, reduced global poverty, and raised standards of living. But since about 2010, trade growth has slowed. It's no longer growing faster than GDP. Now, some slowdown was inevitable. Once most economies were participating in open trade, there was less capacity to expand trade further. China can only join the global trading system once. Still, part of the slowdown reflects shifting politics. The benefits of open trade have not been evenly shared. When low-cost producers in exporting countries undercut domestic producers, workers who lost their jobs lost more than they gained. This has eroded public and political support for globalization, resulting in a pullback from open trade. As a result, trade barriers have been rising for the past dozen years. And now we're in a new era of U.S. protectionism. As you can see in chart 2, U.S. tariffs have not been this high since the 1930s. U.S. tariffs are doing at least 2 things. They're reducing bilateral trade with the United States, and they're rerouting trade as exporters look for ways to get around tariffs and seek out new partners. China, in particular, has been ramping up trade with the Global South for several years, and this has accelerated with new U.S. tariffs. Have a look at chart 3. China's entry into the global trade system and rapid growth over the past 25 years brings us to the second megatrend. The United States no longer dominates global trade. Chart 4 shows trade flows between countries in 2000 and in 2019. The change is dramatic. In 2000, the United States was dominant. Now, the global trading network has 3 main hubs: China, the United States, and the Euro area. The global trade network has also become far more complex, much denser than it was 20 years ago. As China expanded its trade, it also moved up the value chain. 20 years ago, advanced economies were happy to buy low-tech consumer goods produced by state capitalism in China. Prices were low, which benefited U.S. consumers. But now, China is competing head-to-head with the United States and other countries in advanced manufacturing and high-tech. The global trade system is designed for private companies competing in an open marketplace. But in China, trade is being used as an instrument of state-directed growth that gives Chinese companies an advantage over their competitors. In response, advanced countries have increasingly embraced industrial policy across a widening spectrum of strategic industries. China's ascendance and use of industrial policy has also spurred the swerve in U.S. trade policy. As U.S. tariffs on Chinese goods peaked in April at about 150%. Now, since then, tensions have de-escalated considerably, but the effective tariff rate on China remains high at about 40%, and both countries have imposed export restrictions on some strategically important products. That brings me to the third megatrend. While the United States no longer dominates trade, it continues to dominate global financial flows. Chart 5 is the comparable chart for financial flows. The United States has the biggest equity and debt markets in the world. The size and dynamism of the U.S. stock market fuels growth companies. The depth and liquidity of the U.S. Treasury market, along with very low perceived credit risk, have made U.S. Treasury bills the global risk-free asset. This has increased demand for U.S. dollars and made the dollar the global reserve currency. Providing safe assets to the world has its benefits. The United States can borrow money to finance growing fiscal deficits at a lower rate than it could otherwise. For many global investors, the question now is whether U.S. dominance in global financial flows will ebb as the United States pulls back from global trade and runs large fiscal deficits. The recent performance of the U.S. dollar may be telling us something. Typically, we'd expect U.S. tariffs to support the U.S. currency, but instead the greenback has depreciated, and the price of gold, another safe asset, has risen. President Trump's Liberation Day shook global confidence, and the dollar's safe haven role was called into question. Stock markets have since recovered, but the dollar has depreciated by about 10% against other major currencies since the start of the year, and the price of gold is up over 40%. Now, it's too early to know if this is the start of a new era. For now, the greenback remains dominant, and without a clear alternative, I suspect it will remain the global reserve currency for the foreseeable future. But for many, its value as a hedge in times of stress has been dented. And President Trump's attempts to influence the Federal Reserve are raising questions about the independence of U.S. monetary policy. The final megatrend I want to touch on is the persistence of global imbalances. And by this, I'm referring to the persistent trade deficit in the United States and the large and continuing surpluses elsewhere, especially in China and the European Union. And you can see this in chart 6. International capital flows are the flip side of trade imbalances. To fund its trade deficit, the United States relies on net capital inflows, foreigners purchasing U.S. debt and equity, as well as foreign direct investment. In other words, the United States must attract savings from abroad because it does not save enough at home. In contrast, China and the European Union both have excess savings. Domestic factors are the main reason for the widening of imbalances between these major economies. China's consumption has been persistently weak. Households in China hold high precautionary savings because social safety nets are not well developed and the property sector has been shaky. In the European Union, investment has been weak relative to savings because opportunities are less attractive, especially in high tech. In the United States, it's the opposite. Consumption and investment are high, fiscal deficits are large, and the savings rate is low. So the United States is running a trade deficit, and the biggest counterparties are the European Union and China. Now, I want to stress that imbalances are not inherently bad. Global capital flows are part of a well-functioning international trade and financial system. But risks accumulate when the imbalances grow unsustainably and the necessary adjustments do not take place. Countries or regions with a trade surplus, in this case, China and the European Union, generally face little market pressure to adjust. Usually, most of the adjustment will be forced onto the country with a trade deficit, in this case, the United States. But because the US dollar is the global reserve currency, foreign investors have been willing to finance US spending. So imbalances persist. So why do we care? Because we've seen it go wrong before. In the lead up to the 2008-9 global financial crisis, imbalances built up as China ran large trade surpluses and the United States ran large trade deficits. The U.S. subprime mortgage implosion was the product of flawed financial innovation and lax regulation. But the massive inflows of foreign capital to the United States made a local problem global. They sparked the worst financial crisis since the Great Depression. Global imbalances narrowed after the crisis, but they've started to grow again. Because of insufficient domestic savings, the U.S. fiscal deficit must be funded in part by foreign investors, and they could become less enthusiastic about U.S. assets. At the same time, U.S. government debt is increasingly being purchased by non-banks, particularly hedge funds, using highly leveraged strategies. This is increasing leverage at the very core of the financial system. These are vulnerabilities. And no, U.S. tariffs probably won't fix global imbalances. Lower U.S. imports from the rest of the world will likely come at the cost of lower U.S. exports. But as long as the United States is spending more than it's producing, it needs to import more than it exports. Okay, that's it for the megatrends. What are the implications? These megatrends, I took the time to go through this because I wanted to highlight that, yes, President Trump has really swerved policy, but these trends did not start with Trump. They have been building for some time. And now U.S. tariffs, combined with the unpredictability of U.S. policy, are increasing uncertainty, they're shifting relationships, they're weakening global demand, and they're reducing the efficiency of global supply. What are countries doing? Well, countries around the world are adjusting their supply chains and they're seeking new partners. China's reach into emerging markets is increasing. New partnerships support China's quest for a multipolar world where the United States has less geopolitical weight. The European Union is also making changes beyond simply diversifying trade. It's trying to tackle a number of its internal challenges that have hampered its competitiveness. The global economic fallout from the U.S. trade war has so far been milder than first predicted. And that's both because U.S. tariffs are not as high as initially feared and because retaliatory tariffs have been limited. But the full impact has yet to be seen. Many U.S. households remain cautious about spending, and U.S. employment growth has slowed. In the Eurozone, growth looks to be softening as U.S. tariffs weaken exports. In China, export substitution to Asian markets has offset the worst effects of tariffs so far, but businesses are investing less and growth looks to be slowing. So what can governments around the world do? Well, when the United States raised tariffs sharply in the 1930s with the Smoot-Hawley Tariff Act, most leading nations responded by erecting their own tariff barriers. The combined impact was severe, contributing to the depth and persistence of the Great Depression. This time, countries have avoided escalating a global trade war. That's good. But they could go further by strengthening trade ties where possible. Look, the era of open trade with the United States may be over, but the rest of us can still deepen trade with others. To do this, we need our multilateral institutions, particularly the WTO and the IMF, to work together to address the problems of unbalanced trade and lack of adjustment. Together, countries also need to be prepared for new financial stability risks. We need our financial supervisors to strengthen surveillance of financial vulnerabilities, especially as hedge funds and other non-banks play an increasingly important role in our financial system. Here, the IMF and the Financial Stability Board need to work together to identify potential systemic risks. And for their part, businesses need to consider both geopolitical risks and the resilience of supply chains along with efficiency. More industrial policy means chief executive officers need to think about how their corporate strategy interacts with national priorities. These national priorities may allow business to take more risk, which will fuel growth, but they should not be used to create monopolies. Central banks. Well, we also have a role to play, but actually it's limited. Monetary policy cannot undo the damage caused by tariffs. At best, monetary policy can smooth the path in the short run, supporting economic growth while ensuring inflation is well controlled. And that brings me back to the impact here at home in Canada, both in the short term and in the longer term. So first, the short term. Trade growth in Canada had slowed well before the re-election of President Trump. And if you look at trade as a share of GDP in Canada overall, it slowed in about 2000. But Canadian exports have declined sharply since President Trump imposed new tariffs on Canada and has created considerable uncertainty with tariff threats and reversals. The pain is falling primarily on key sectors: steel, aluminum, and motor vehicles. Last month, we saw tariffs increased or extended to more goods, including copper and softwood lumber. High tariffs are also being imposed on exports that are not compliant with the Canada-US-Mexico agreement. Here in Saskatchewan, actually most of your exports comply with CUSMA, as the Premier just said, 95%. So actually you're not being affected much by U.S. tariffs, at least not directly. If the U.S. slows, you will be affected by that, but you're not being affected much by U.S. tariffs. You are, of course, being severely affected by Chinese tariffs on canola. The economic impact for the country has been a whipsaw. Growth held up actually pretty well at the start of the year, but that was driven largely because exporters were trying to ship as much as they could to get ahead of tariffs. That boosted our exports. This reversed in the second quarter. Exports dropped almost 27% in the second quarter, and GDP contracted 1.6%. The sharp drop in exports is hurting the job market. The unemployment rate rose from 6.6% in February to 7.1% in August. Here in Saskatchewan, as you're well aware, it's much lower, 4.7%, lowest in the country. But looking at the country as a whole, what you see is hiring and employment in trade-affected sectors is down sharply, and employment growth in the rest of the economy has slowed. Many businesses have also told us they've paused investment plans given the elevated uncertainty about U.S. trade policy. Let me switch to the longer term. In the longer term, increased trade friction with the United States means our economy will work less efficiently. There'll be added cost, and incomes will be lower. Chart 7 shows the bank's assessment of the growth path for the Canadian economy before U.S. tariffs. That's the blue line. And with U.S. tariffs based on trade policy as of the end of July. That's the orange line. Remember the blue line and the orange line. Now, monetary policy cannot undo the efficiency costs of U.S. tariffs. It can't bend the orange line back up to the blue no tariff line, nor can counter-cyclical fiscal stimulus. What could? What could is positive structural reform. Canada has a choice. We can live with the structural impact of a more protectionist United States, the lower path. Or we can improve our productivity and competitiveness and bend the orange line back up or even above the blue line. Canadians have braced the power of economic patriotism. Elbows up. But now we need to roll up our sleeves and do the hard work to be more competitive. We need to diversify our trade by growing our internal market and finding new overseas markets. And we need to improve our productivity and make ourselves more attractive to investors. That work has started. And I've spoken about these things before, so I'm going to be brief, but hopefully clear. There are some things we could do quickly at little fiscal cost if we have the determination. There is momentum to eliminate interprovincial trade barriers. Saskatchewan has been a leader. We need to take a comprehensive approach that lowers the cost of doing business across the country. This includes removing trade barriers and many small regulatory differences. It also includes mutually recognizing provincial labor accreditations for many professions. We also need to remove unintended barriers to investment by shortening regulatory approvals and reducing regulatory uncertainty. Then there are other things that require investment and will take time to build. But the sooner we start, the sooner we will reap the benefits. Here I would include better east-west transportation links to grow our internal market and get products to overseas markets. I'd also include new port capacity to reduce our dependence on the United States. If we can get our products to overseas markets, we have some of the best market access in the world. Canada has trade agreements with 50 countries beyond the United States. But businesses and governments could do more to leverage these agreements. We need to learn from the past. The recession of 2009 highlighted just how vulnerable we are to a drop in U.S. demand. And back then, everybody was talking about diversifying away from the United States. But the reality is, not much happened. This time, we need to follow through. Finally, we also need to nurture and support our long-standing strengths. We have the ingredients to attract more foreign capital. We have effective governments and rule of law. We have abundant energy and other resources. We have a diversified industrial structure. We have a strong labor force, healthy participation, a good immigration system, and broad access to quality education. But our immigration system has been strained, and our university and colleges are facing a financial squeeze. We can't take our strengths for granted. Increasing productivity and improving competitiveness may not be every Canadian's biggest priority. But if we can bend the orange line back up or above the blue line, everything from housing to healthcare becomes more affordable. Productivity growth is what sustains increases in our standard of living. Okay, that was a lot. I need to wrap up. But before I do, let me return to the role of monetary policy in all this. Tariffs have weakened our exports and GDP growth. They've slowed the job market, and they've added costs. Monetary policy cannot undo the damage caused by tariffs, but we have a role to play, supporting the economy through this period of adjustment while maintaining price stability. Last week, the bank lowered its policy interest rate to better balance the risk we face as the economy adjusts to a new trade relationship with the United States. We are proceeding carefully, with particular attention to the risks and the uncertainties. And as we demonstrated last week, we are prepared to respond to new information. We will support economic growth while ensuring inflation remains well controlled. But as we all deal with the immediate fallout of global fragmentation and rising protectionism, business leaders, policymakers alike need to think about the deeper structural weaknesses that threaten the resilience of our economy. There is no better time than now to deepen investment, improve productivity, and expand our markets. We have the capacity to overcome the negative impact of new trade restrictions with the United States. Elbows up has been galvanizing. Now we need to roll up our sleeves. There's a lot of hard work to do. Thank you very much.
Well, thank you very much, Governor. Thank you very much, Governor. We have a few minutes left, and we would like to spend some time maybe democratizing this event a little bit. We've got some time for a Q&A. Not very many Q&As, so I will suggest if you've got something that you would like to ask the Governor, you work up the courage quickly and find your way to a microphone so we can get to it. I appreciate, Governor, your ability to add context and distill the complexity of global trade into actionable items that feel like they can hit home in Saskatchewan businesses and homes. And you mentioned at the end of your presentation the action you took on the interest rate. And I want to talk a little bit about that to get started. And so the interest rate was historically low during COVID. And then following that, a rapid rise. And then now we're seeing a moderation back. I wanted to ask whether or not you think there is a natural interest rate for Canada and the economy.
Well, we do have a concept, a natural interest rate concept. We actually call it neutral interest rate. But I would warn that it's kind of a theoretical concept. We don't observe what this neutral interest rate is. We do try to estimate it. And when we try to estimate it, it's between about 2.25% and 3.25%. So at 2.5%, we're in that range. But I would caution that, first of all, we don't really know what it is, that we can't observe it. Second of all, what is this neutral rate of interest? Well, it's where the interest rate would settle if inflation was at target, the economy was operating its capacity, and there was no shocks buffeting the economy. Well, that never happens. And certainly, that's not the situation we're in now. Yes, inflation is close to 2%, but there's considerable slack in the economy. The unemployment rate, not so much here in Saskatchewan, but in the rest of the country, is sort of well above its normal level. And there's nothing natural about the adjustment we're facing right now, dealing with with our largest trading partner. So, what that means is that, as a practical matter, when we sit down and deliberate over interest rates, we're not thinking too much about the neutral interest rate. We're thinking about this disruption to trade. It's adding costs. I mean, many of you are running businesses, and what we're hearing from businesses is their new costs. You're looking for new markets. You're looking for new suppliers. That has new costs. Your trade's getting disruptive. There's uncertainty. That has new costs. We have to make sure that those cost pressures don't become inflation. At the same time, the economy is weakening. That's putting downward pressure on inflation. We need to support the economy through this adjustment so we can keep inflation close to 2% going forward. That's where the economy functions well. So as we're deliberating over interest rates, that's really what we're focused on. We came to the conclusion last week that the risks had shifted, the economy had weakened further, the upward pressures on inflation were looking more contained. It made sense to drop the interest rate 25 basis points. So that's what we did.
Excellent. Checking to see if there's any questions on the floor. I don't see any just yet, so don't worry, I have more. You spoke today about, obviously, Canada's economy, the importance of where we stand in a fluctuating global trade environment. Can you talk a little bit about the connection between trade policy at a national level, foreign policy, and monetary policy, and how those things work together?
It's a good question. So first of all, foreign policy, trade policy, immigration policy, these are all policies of governments, elected governments. They're not policies of the Bank of Canada. We have no role in these policies. But all those policies, of course, they affect the Canadian economy, and so we need to understand the implications. And the reason I took you through sort of a quick summary of the last 20 years of global trade was to send the message that, yes, President Trump is having a big impact, but these trends have started before President Trump. They're not going away soon. There is a big structural change. This is not a cyclical downturn with a bounce back. It's a structural change. It needs a structural response from governments and from businesses. To come back to our role, the Bank of Canada, we're a stabilizing force. We're going to keep inflation reasonably close to 2%. We're going to do what we can to support the economy through the adjustment. We try to ensure that the financial system is working for Canadians, working for businesses. It's stable. The two other things I would say we do here. in order to take our decisions, we do a lot of analysis. So we've been doing a lot of analysis of what the impact of U.S. tariffs are. And we're publishing that in our monetary policy reports. I talked about it today. We don't have a crystal ball of the future, but certainly the analysis we're doing is helpful for our decisions, and we're sharing that with Canadians. Hopefully it's helpful for some of you in your business decisions. And then the third thing that we do is I meet very regularly with my colleagues around the world, at the G7, at the G20, at the International Monetary Fund, at the Financial Stability Board. We're comparing notes. We're looking at, yes, it's more difficult to do business with the United States. We're all facing that. What can we all do about that together? We're putting our heads together. We're trying to find solutions. Many of those solutions will end up being the responsibilities of elected governments, but central banks have a role to play to bring evidence to the table, to bring analysis to the table. It's non-political, it's evidence-based, it's facts-based. That's what we do.
Well, that's reassuring to hear. I think I will ask maybe one more question here before we wrap up for the day. And really, it's an extension of your call to action about rolling up our sleeves here, not only in Saskatchewan, but all of Canada. If you were going to give some advice, perhaps, to the business owners and operators in this room and across the province here today, what would you suggest that businesses can do or should be doing in this time of economic uncertainty, and how will the bank support that?
Well, I get asked this question from time to time, and I have to say I'm always a little reluctant to answer it because, look, you all know your businesses way better than I do. You know your markets, you know your books, so you need to figure out what to do. But I'll give you two bits of advice. One more in my previous role as Dean of the Business School at University of Toronto. One of the messages I had to businesses, there's always uncertainty. Right now, uncertainty is more elevated than usual. And we would all like to wait until, the fog had cleared, we had clear line of sight, and we were super confident that business opportunity was going to pay off. The problem is all your competitors are doing that too. And so by the time you wait till it's a sure thing, the one sure thing is that somebody else will have taken that opportunity. So, look, we're all having to shorten our horizons through this period of uncertainty. We're doing that at the Bank of Canada. We're shortening our horizon. We're more focused on the risks of uncertainties. But we have seen a bit more stability lately. I do think instead of publishing different scenarios, I do think we're going to get back to a baseline forecast. We're going to have to start being more forward-looking again, and that's what businesses are going to have to do too. The second thing, and I already mentioned this, what we're going through now, it's not like COVID. It's not like we're closing the economy and it's going to just reopen and bounce back. It's not like, this is, you know seasonal fluctuations better than anyone here in Saskatchewan. It's not like, okay, you got a bad harvest one year and it's going to bounce back the next year. It's not like a typical business cycle where you get a bust followed by a boom. This is a structural change. And if you go back, that's why I put that graph of the blue line and the orange line. Unless we do something about it, the orange line's staying below the blue line. And governments have a role to play, but ultimately it's going to come down to businesses. Governments can try to help open some new markets and get trade agreements and build infrastructure to help you get product there, but ultimately you've got to go in and you've got to sell in those markets, and it's going to be harder. There's a reason we do so much business with the United States. It's easy. They're close. We watch the same TV shows. We cheer for the same sports teams. It's easy. It's now gotten harder, and that means that we need to make a structural change here.
Okay. One final takeaway: we got to bend the orange line. Back up. I get it. Thank you very much. Listen, I want to say thank you to everybody for spending part of your day with us today. Thank you to the Chamber and Jason, your team, for helping us pull this together. Thank you for our dignitaries for being here today, Premier Moe. But most of all, thank you, Governor Macklem, for taking the time to be here in Saskatchewan and share your insight and wisdom with us in the room here today. So thank you.